Well, first up, let's talk about taxes. Yes, the market has rallied significantly in the last 1 year. The Nifty 50 has returned 30%. And guess what? The Nifty Mid Cap Index and the Nifty Small Cap 50 Index have both given close to 48%. Definitely great news for all of us investors out there in the mutual fund markets, in the equity markets, of course, in the direct equity markets as well. But we are talking about a 1 year time horizon. When you invest in the equity markets for more than a year, any gains that you enjoy on that are counted as long-term capital gains. And I'm sure many of you all have enjoyed gains. If those gains have exceeded 1 lakh rupees, you will have to shell out a 10% tax. But what if I tell you that you can actually efficiently manage your transactions and your tax, your dealings in such a way that your tax bill is cut to the minimum? That's essentially a crucial crux of efficient tax planning. So let's talk about this a bit more. We have with us Preeti Khurana, the Chief Editor with ClearTax, joining in on the show. Preeti, thank you so much for taking out time to talk to us on the Money Show today on this topic. So like I said, the market has rallied significantly in the last 1 year, may have resulted for some big gains for some shareholders as well. Many may now would think that it's a good time to book out. The market has rallied, so on and so forth. For whatever reason, now they are looking at booking out and booking their profits. However, the capital gain will be subject to tax. So what would you recommend for efficient tax management, Preeti?
Sure. So, as you rightly said, just in the past few months since March, a lot of taxpayers would have earned significant gains if they decide to exit right now. And mostly, if you've held on to equity shares or equity mutual funds for a period of less than 12 months, then you would end up with short-term capital gains. But if you go beyond 12 months, then you would have long-term capital gains. Now, the tax rates for these two are different. Long-term capital gains would get taxed at the rate of 10% if they exceed rupees 1 lakh, but short-term capital gains get taxed at the rate of 15%. So firstly, the best thing to do would be to look at how much gains you have both on short-term and long-term, and whether you have any losses. So if you have losses, then short-term capital losses would get knocked off against short-term capital gains and also long-term capital gains. But any long-term capital losses will only get knocked off from long-term capital gains. So that's the primary rule. Now, one has to look at what is the tax outgo looking like after considering this knockoff with the losses. Therefore, you need to sort of figure out your capital gains, and then if that is beyond the 1 lakh threshold, so your capital gains only that exceed the value of rupees 1 lakh get taxed at the rate of 10%, and also there is no indexation. So keep all of these things in mind and see if you would like to harvest some gains. If you've already harvested, then of course you will end up paying taxes. But a lot of people use the tax harvesting strategy where they book a certain amount of profit in a particular financial year and then get into those stocks again before the next cycle begins. So if you are somebody who's doing that, it could be a tax efficient way of looking at your gains. But again, just tax harvesting may not be optimal. So you have to also look at this as a strategy to rebalance your portfolio. So broadly speaking, figure out what your long-term capital gains are, what your short-term capital gains are. If you have losses, then and you have not booked them, so go and also book your losses so that you're able to take benefit of this while you're sitting on gains, and then calculate how much tax outgo you really need to do on equities. So that's just about equities.
All right. Preeti, there are, however, a section of shareholders who do not necessarily want to book out now. In a way, that's good because it gives them some more flexibility as well on how they can maybe save on their tax bill. They are, though, on an unrealized basis, staring at a gain of more than 1 lakh rupees. So how would you recommend they go about their potential dealings to cut down on that tax bill?
All right. So, you don't want to exit your investments, but you still want to make sure that your losses, are sort of taken care of or whatever. You don't want to pay tax on your gains. So again, I would say estimate how much gains you're sitting on and see if there's something that you want to book a loss on. And that's the way that, that's typically how tax harvesting works. But you don't want to book any gains is what you're saying. And you still have some taxes which are already due. Then one important strategy would be that you might have certain investments which have been loss making, which are still in the red, and then this could perhaps be the right time to exit from those. If you feel that it could be a good strategy to continue to hold on to them, then perhaps you exit from those right now, book your losses whatever you have so far to minimize your gains and to reduce the tax outgo, and then you can sort of get into them again within a day or so.
Okay. Preeti, let's talk about capital losses as well. There are some shareholders out there who may have, they may be staring at some outliers in the market that are not exactly performing well for them. So there is that risk of a capital loss. How can these shareholders use it to knock off a little bit from their tax bill as well?
That's right. So if you had losses earlier, each kind of loss you can carry it forward for 8 years. So every time you file your tax return, you actually have to say these are losses carried forward from which particular financial year, and each financial year's loss is allowed to be carried forward and adjusted up to 8 years, right? So every year it will be available to you for knockoff, and then whatever comes first, whatever loss comes first, you knock that off first, and then that's how you go on with it. So it will be available to you. In the example you gave, 4 years ago you had a loss, you reported it, and it is present in your tax return, and if you're reporting any gains, it will be allowed to be adjusted.
So can these capital losses then, if you could just tell our viewers about how they essentially can be knocked off?
Sure. Yeah, I think that's a very valid question. We always underestimate what capital losses can do to us. So first thumb rule is that if you have short-term capital loss, you can knock it off against short-term capital gains and also long-term capital gains. But if you have long-term capital loss, that only gets knocked off from long-term capital gains. So that's the basic premise. If you are unable to knock off losses, that's not a big worry. So the big worry is on paying taxes on the gains. Any losses that you are not able to knock off, you can carry them forward for 8 years. So you can continue to carry those forward, and in the future years when you have any gains, you will be allowed to knock those off. So but the most critical step in being able to knock off your losses is filing your tax return. If you don't file your tax return, then you may lose the right to carry forward your gains and to adjust them for future capital gains. So first step, if you have any losses, report them, look at how much what they are, and if you're able to knock them off, then you're reducing your capital gains, you're reducing your capital gains tax. And if you're not able to knock them off, then remember to report them properly and carry these forward into the future years, when they will be available to you to again adjust from your long-term capital gains or short-term capital gains, as I said before. Also, when you're looking at long-term capital losses, these could be from equity, but if you have long-term capital gains from another asset, say for example property or something, then you would be allowed to adjust those long-term capital losses as well. So you have to look at the whole picture. Perhaps it would help to draw up a rough tax return to really see where you stand in terms of your total tax outgo on capital gains, and then take the next step.
All right. Okay. Preeti, debt funds. Let's talk about that and the tax treatment on that as well. Because in the last 1 year, these two have given double-digit returns for debt fund holders. How does the taxation differ here, and also how does the whole capital gain, rather the capital loss offset against capital gain bit work?
Sure. So if you're looking at debt mutual funds, then all debt mutual funds follow a taxation policy which is different from equity mutual funds. The holding period is also different. As compared to equity, you're supposed to hold your debt mutual funds for a period of 3 years for them to qualify as long-term capital gains. So against equity, equity allows you long-term capital gains after 12 months, but in case of debt mutual funds, that period gets extended to 3 years. Now, after 3 years, when you exit your debt mutual funds, you have to pay a tax of 20% after applying indexation. So you also get indexation and you face a higher rate of tax, which is 20%. And if you have short-term gains, which is you held on to your debt mutual funds for less than 3 years, you sold them within 3 years, then you have to pay tax according to your own slab rates. So you add it to your total income, you report it there, no special tax rates. It gets included as part of your total income, and whatever tax rates will apply to you, that is what you will pay on short-term gains from debt mutual funds.
Understood. Well, Preeti, I cannot not ask you this question. We are in tax saving season currently. We have, about a month to go. And we always tell our viewers, do not leave it to the last minute. Now, I'm going to ask you a bit more nuanced question. Many a times when we look at tax saving, we also want returns as well. So we try to look at those products that give us the best return, in a way mixing financial planning and tax planning. Do you think that's the right approach to follow?
Well, the first step to any kind of investing is to look at what your goals are. So, and even before that, look at how much debt and equity you have. So basically, what is sitting in your portfolio already? Do you have a lot of EPF? Are you doing a lot of PPF? Do you have a large number of fixed deposits? And what is the kind of role that equity plays in it? Now, if you're already sitting on corpuses which are giving you a fixed rate of return and which are giving you an assured return, then perhaps you need to start looking at equity, because it's only with equity that you will be able to sort of beat inflation and get better returns. So if you are a person who's heavily into, say, PPF, and you have large EPF balance, you have a lot of fixed deposits, then for the purpose of tax saving, you can get into ELSS. So if you want to exhaust your ATC, consider ELSS. It has a 3-year lock-in, but mostly your gains will look excellent in a 5 to 7 year time frame, and you'll be able to exit very smoothly. You'll be able to invest very smoothly. If you are a risk averse person, if you're somebody who's continuously investing into the market through mutual funds, through SIPs, then it may be a good idea to get into PPF, or if you have a PPF account, then exhaust that 1.5 lakh limit there. Ideally you should do it when the financial year begins, but if you haven't done that so far, then sort of do it now. But again, to answer your question, just don't look at investing purely from the lens of tax saving. So tax saving is one aspect, but largely look at what that kind of role that investment would play in your overall portfolio. And based upon that, the second thing to look at would be from a tax saving point of view. A lot of people, I just like to warn them that, you get into products, perhaps say a ULIP or an LIC policy or whatever kind of insurance policy, because it appears to be attractive and it saves you taxes. But you need to see if it really has a place in your portfolio, if that is the kind of investment you would like to get into, because both ULIPs and life insurance policies require commitment of premium over a longer period of time. So you may be committed to, say, a 5-year or a 10-year premium paying cycle. So therefore it becomes even more important to truly understand the role of such a product in your entire portfolio. And ideally, if like I said, if you're heavy on PPF, EPF and other fixed income products, then go towards ELSS. But if you're already heavily into equity, then perhaps you should do PPF, and then sort of define that strategy for yourself and see year on year, if you're able to comply with that, that's a great way to do both tax saving and investing.
Okay. All right. Well, Preeti, you know what? I request you to stay on with us. Ladies and gentlemen, we are going to take a very short break, but when we return, we'll be back with our Ask the Money Show segment, where we'll open the floor for our viewer questions and queries. So you can connect with us by writing in on the Money Show at etnow.tv, and we'll get them answered. Stay tuned. Welcome back. You're watching The Money Show on ET Now. It's time for our Ask the Money Show segment. So write into us on themoneyshow@etnow.tv and we'll get your questions and queries answered. So very quickly, let's take our first question. TG Venkateswaran asked us, kindly explain the operation of the Leave Travel Cash Voucher, the LTC Cash Voucher, a new announcement from the FM instead of the leave travel allowance that you get when you travel, which obviously will not be able to happen. You get a voucher for goods that you have spent from your company. So he says the deemed LTC fare for a family of 4 is 75,000. So the employee is required to spend 2.25 lakh rupees on goods and services that have a GST of 12% or more. Then he will get a reimbursement of 2.25 lakh rupees from his employer, while tax exemption will be restricted to a maximum of 36,000 per person. So that comes to 1.44 lakh rupees. So kindly clarify the exact position. I understand where his confusion is because both the amounts are vastly different, almost a 1 lakh rupee difference. So Preeti, if you could explain how this LTC works.
Right. So, just to help you understand this very, very easily, just look at what is the LTA allowance that you get from your employer. Now, for private sector employees, usually this forms a part of your CTC and you have a predefined number that this is your total LTA allowance. In no situation, your tax exemption from this cash voucher scheme can exceed this number of LTA allowance that you get from your employer, or rupees 36,000, whichever is less, right? So that's the ground, on which you should be working on this, basis which you will be spending money. So in no situation will it exceed the balance that is available under your CTC. There's no chance your employer will give you exemption exceeding that. Now, once you've identified what is the minimum exemption you will get, either it's rupees 36,000 or it is the allowance that your employer gives, then do a 3x of that. So let's say if it's 36,000 and you do a 3x of that, you need to spend 1,44,000 on goods or services which attract a GST rate of 12% or more. Usually this is either mobile phones or air conditioners, or you'll have certain other white goods, even hotels. If you're doing a vacation, if you're able to do a vacation, then that also might attract a rate of higher than 12%. Then these are the various goods and services which are eligible to you, but there are still certain more conditions you need to satisfy. You should have made the payment via electronic means. You should have a bill. It should be in your name. And also remember that the rules for private sector employees for claiming this LTA have not yet been notified. That's another thing. The other thing is that this expense should have only been incurred between the time period starting from 12th October 2020 till 31st March 2021. So only in this window, when you do this kind of an expense, is when you can claim. But in no situation your total exemption can exceed either the value that your employer has given to you or 36,000, whichever is less. So you may be spending like a 3x or a 4x even, based on the number of family members, but the exemption allowed to you will not exceed that value. So you need to figure out what is it that you need to spend and what is your eligibility looking like.
Okay. All right, fair enough. Preeti, let's take on board one more question. Raghu Tantri writes, I had filed an original income tax return for AY 2021 and identified a few corrections, hence filed a revised return. Should I e-verify both original and revised returns, Preeti?
Okay, so whenever you revise your return, the tax department does not look at the return that you had originally filed. So every time you revise, the previous return is practically redundant for them. So you don't need to e-verify those. Only the return that you finally submitted is what you need to e-verify. That's the only valid return.
Okay, understood. So just verify your final return. You need not bother then verifying the original return, because then the department will look at only your final revised return. Great. Preeti, on that note, thank you so much for joining us today on The Money Show and, helping our viewers out as well with their tax-related questions and queries. Folks, if we've not been able to take your question, don't fret. We'll be back every day on The Money Show. break, but when we return, education loans continue to be taken by students, parents at a record high level. This despite the pandemic. So we'll tell you how you can manage paying off your educations through efficient investments, and also, of course, tips and tricks on getting a good deal on your education loan. Don't go anywhere.